Hi, my name is Garrett Finn, and I believe we should buy Johnson & Johnson to add to our portfolio as a defensive stock that still has significant upside. Some background information about J&J is that they are extremely diversified within the healthcare industry, have had 53 years of consecutive dividend increases, 31 years of adjusted earnings growth, are viewed as having very effective management, and are the largest healthcare company in the world with established relationships and a massive research and development budget, which allows them to stay significantly ahead of their competitors. In analyzing Holt's relative wealth chart, we can see by looking at J&J's CFROI levels that the company is able to generate excess returns above their cost of capital. This shows not only effective management but an effective business model as well. Something important to realize about their CFROI is that almost no fade is implied by the model due to the fact that Holt rates J&J as having an empirical competitive advantage because of its stability, large market cap, and strong brand name. In looking at their asset growth, we can see that it may appear somewhat volatile in recent years, but if we include growth of intangible assets such as patents, which are just as important to companies like J&J as hard assets are, we can see that asset growth has been relatively consistent. Evaluating J&J with Holt's three-driver model, we can see that J&J sales growth has had its ups and downs, but the company was still always able to show an increase in earnings. For the last 4 years, J&J has maintained consistent sales growth, and over time, if J&J has proven anything, it will be that it will continue to remain profitable. Moving down, as we can see, J&J's operating margins are high and following an upward trend, which shows a strong cash generational ability. Looking at their asset turns, some may be concerned if this were a regular company, but because J&J continues to increase the size of their business by creating and developing new technology, as well as acquiring other firms such as Alias Biopharmaceuticals in 2014, their asset base is truly enormous, which is why their asset turns are so low. J&J's biggest competitors are Pfizer in the US and Merck headquartered in Europe. In comparing J&J to Pfizer, we can see that J&J's CFROI levels are significantly higher than Pfizer's, and that J&J's forecast extends to 2024, whereas Pfizer's only extends until 2019 because J&J is rated as having an empirical competitive advantage pointing to its stability versus that of Pfizer. Asset growth is also important to compare because Pfizer's asset growth base has been either negative or extremely volatile. This implies riskiness in the company and shows they are not investing as much capital as they used to into their business. Finally, to add to the riskiness of Pfizer, we can see that over the last 5 years, sales growth has been declining, whereas Johnson & Johnson's has been growing consistently. To further test if J&J is undervalued, I performed a discounted cash flow analysis based on the financials of Johnson & Johnson. The extremely low beta led to a low WACC, which led me to estimate the conservative terminal growth rate of 1.5% to counterbalance the low WACC, which gave me the conclusion of 33.5% upside, almost exactly in line with Holt's predictions for valuation. To conclude, Johnson & Johnson is the opposite of a growth stock. J&J should be viewed as a long-term investment, as returns will be seen because the company is undervalued, pays significant dividends, and will continue to grow in the coming years due to effective management and future potential. Through their strong fundamentals, which are demonstrated through the Holt valuation methodology and a standard discounted cash flow, I believe Johnson & Johnson is a strong buy, especially for long-term value.